Hello, everyone. I wanted to thank everybody for joining. We'll give everybody a couple minutes here to sign on, and we'll get started. I guess we can get started now. Again, thanks for joining, everybody. This is our Agile Trader Talk webinar. We'll be talking about MBS pooling, a little overview, talk about market dynamics and best practices. I want to introduce you to our panel here. I'm Tawaba Balbi with Agile. We have Ryan Ferger from MBS Multi-Bank Securities. He's the Vice President of Trading. He's the head Ginny trader there. He's got a nice background, comes from Countrywide, Jefferies, US Bank, and he's been at MBS for a while now, so we're happy to have him. And we have Phil Kafka from Town Mortgage, almost a 30-year vet in the industry, been around multiple correspondent lending channels, also as a CPA, worked on the accounting side on the street. And we also have Andrew Rhodes, who is the Senior Director at Mortgage Capital Trader, MCT. He's manages about almost 30 traders, pushing 300 client lender accounts. So thanks, guys, for joining us. And we're happy to have you, and hopefully we'll give some beneficial information to our audience today. I'd like to start off with a little market color, Ryan, if you want to kind of talk to us about what's going on in the market, maybe just a look back where we are now, and then what do you think is going to happen going forward in this crazy environment that we're in?
All right. Well, thanks for having me. To give a relative history look back, obviously last year, we went through a very large, Fed began to hike rates at a very fast pace. Loan balance as a whole seemed to, relatively underperform, as a call protection needed, less payout with, the market selling off and the rate environment just providing mortgages extending out and not needing as much, call protection in the market. So the loan balance as a whole just, seemed to kind of crater, if you want to say that. Now, the market, I would say last year versus this year held up like relatively better because we had a wide variety of buyers still in the market. Now, that demand did rise at the beginning of this year, mostly due to, we kind of anticipated the end of the hiking cycle and seeing some of the buyers anticipate that loan balance demand coming back into the market. Now, what changed? Well, a lot of that had to do with the failures of, SVP and Signature Bank. That demand for the paper seemed to just erratically erode away, given that those two bank deposits, or not their deposits, but their bank holdings essentially being taken over by the FDIC. So, but then what then happened was, as I'm sure a lot of you are aware, is that the Fed had to liquidate those portfolios, and that process has been continuous up to, they're still liquidating them as of today. Just to give a quick number, we're about, I think it's around 90% through as far as the liquidation of those portfolios on the spec pool side of things. I believe it's somewhere around like 50% for the more like esoteric stuff like CMOs and and some other paper that they had held in their accounts as well. Now, what did those, the overhang of those banks do? It essentially did a couple things. It widened out mortgages versus treasuries. And the biggest thing of all is it removed a very large natural buyer of a lot of paper across the board, which, banks are just not participating in the market as much as they used to. And the expectation for that is it probably won't come back for some time. A lot of these are severely underwater as far as the paper that they own and the they don't do a mark to market like broker dealers have to do. So they may be 5-10 points underwater on a lot of this paper, and they're not going to continue to add when they're already severely under pressure with their deposits and deposits going out the door and everything like that. So it may be some time. There's some expectations it could be well into 2024, maybe even into 2025. So that kind of sets up like where we're going from here. I think for the remainder portion of this year, loan balance is probably going to, continue to be under pressure. It's starting to, I guess, have some life to it from the aspect of, it's just gotten so cheap in historical standards that there are people starting to kind of, get involved in it with the expectation that, maybe sometime in 2024, we do see a rebound and that call protection needed for others than just the banks that were involved in the paper going forward. But, I think we're still in the early stages of that. The Fed is still in a possible hiking mode. We still have maybe another 25, 50, who knows at this point. We continuously get more data coming out from, them as far as where their target is and where we're going, and just kind of wait and see type mode. So
yeah,
if I had more information than that, I would probably be sitting somewhere else. But
yeah. No, I appreciate the color. Thank you so much. I did want to mention for those that have joined, the call will go out. We'll have a recording going out after this. And if you do have any questions, you can use the side panel and put them out. We'll be doing a Q&A. The Q&A portion will be at the end of the webinar here. But I kind of wanted to jump to the origination side, Phil. Why would an originator want to issue securities versus selling whole loans? Can you speak to that? Maybe some of the risks involved.
Sure, Twab. First, I'd like to say good morning or good afternoon, depending on where you're located, and thank you for having me on the show. I do appreciate that. So it's a very complicated question as to whether you should be issuing securities or selling whole loans, and I'll break it apart. First of all, I'll talk more about Ginnie Maes because my answer for Ginnie Maes could be completely different than my answer is going to be for conventional loans. On the Ginnie Mae loan side, some of the reasons that you would like to be able to control your own destiny with that is you are being able to create your own securities. You're able to work very closely with the broker dealers that are out there, understand what the broker dealers are looking for, such as different loan size pools, low bow pools. Being able to go out there and create different specifications, coupons that your broker dealer might want and be willing to pay up for that. So that's a huge benefit. Also on the Ginnie Mae side, when you're selling your loans to Ginnie Mae, there are no loan level pricing adjusters. So you basically get to create your own pricing off of Ginnie Mae with what you feel the loan level pricing adjusters should be while you're holding these loans in your inventory, such as in your servicing pools, etc. You also have full control over your execution, when you want to do it, how you want to do it. Do you want to hold them longer or sell them shorter? So those are some of the, at a high level, quick benefits to being able to securitize your own loans. Of course, some of the drawbacks to that is that you do have to learn how to create securitizations. You have to work with Ginnie Mae, work with all the systems that Ginnie Mae has, which tend to be quite difficult. And on top of that, you do usually retain the loans. So that means you're either creating your own servicing portfolio, and you need your own servicing team, or you're going out there and you're having to have to hire another company to subservice your loans for you. We could go into many things as far as the difficulties on servicing and subservicing loans, as far as keeping track, reporting. With Ginnie Mae loans, you have to pay every month, whether the borrower pays or not. Those are some of the quick, high-level quick hits on some of those issues that are there. But that's probably the main reason. Some of the benefits, even greater benefits, is that you get, not just what the broker dealers are asking for, but you get paid up. You're on time with the market and with your hedges. So most of the time when I'm creating securitizations and I'm selling my securitizations, I am going to sell them on swap. So therefore, I alleviate the bid-ask spread when I'm doing my own securitizations.
Got it. Appreciate
Oh,
that.
and the last big piece on that, I was just thinking about it, is there is no aggregator due diligence when you're selling securitizations.
Good point. Good point. How do you decide whether to pool up or go whole loan? Can you touch a little bit on that? And Andrew, if you want to follow up and let us know how you recommend your clients doing that. The same.
So best execution models. That's really the bottom line. You need to go out there, and I'm putting all of our loans out for bid, and you need to have a very robust execution model that's going to encompass all of the different types of executions that you can have, not just how long it takes to settle, loan level pricing adjusters, get your spec indications from your broker dealers. Are you able to do the trades on an AOT? Are you not able to do trades on an AOT? Because especially in the Ginnie world, we know the bid-ask spread could be quite wide, especially as we're getting into the higher and higher coupons out there. So I have a whole table that's built where I can look at all of my execution, including potential co-issue, S&P, PIT program, all those different executions. And on top of that, we have all of our aggregator executions in there as well. So you build that and you basically figure out very financially what makes the most sense for your company.
Yeah, definitely agree with that. The robust best execution model is definitely a need when you're trying to maintain your margins and get the most profit out of every loan that you're putting through the hedge. Another thing to take into consideration, especially on the Ginnie side, is whether or not you're going to utilize the 69 basis point strip or the 19 basis point strip. So from a cash perspective, if you have enough cash on hand, then you'll definitely want to best ex between those two different servicing strips. And we're seeing a lot of that go into that 69 basis point servicing strip right now. There are some lenders out there who don't want to take that, the cash implications that come along with the higher servicing strip, so they'll kind of remove that from the execution. But that is something to also take into consideration with everything else that Phil said.
Got it. Can you touch on, do you guys ever trade back with best execution? Is there any reason why you would go whole loan versus pooling up, or even just with dealers? Like, can you touch on that piece? Like, do you always go to the best ex?
Well, when you're selling a securitization, whether you sell a securitization to one dealer versus another dealer, it really doesn't matter, because your securities are going to go through. They're created by Ginnie Mae, and most of the broker dealers that are out there are very good at settling these pools, being able to settle them right away. So as far as selling securitizations, I'm usually going to the best execution. There is, obviously, you always have relationships with some of your broker dealers. Some of your broker dealers you have more TBAs on with, so you might be asked potentially to sell a little bit more to the broker dealers that you do have more TBAs on with. Easier to get out of. You don't have to do the AOTs with that. But unless you're dealing with a loan that for some reason is slightly illiquid, and you might have difficulty selling it to one dealer versus another, or one aggregator versus another, you're most likely going to go with the best execution.
Yeah, I would say if you're looking at it from an aggregator standpoint, definitely time to purchase would be a consideration to take into account, right? So if you have an investor that's out there paying, 10 to 15 basis points through your execution, through your securitization execution, but they're taking 3 weeks to buy the loans, maybe that's too much dwell time for you, and you don't, that's just an additional consideration to take into account, which you could, in that robust best execution model, you should have that component built into the pricing implications as well.
That's exactly what I was going to say. All those extra little components, how long it takes, time, we call those the PITA adjustment. We have that, I will not say the definition of that on this call, but we have that in our model, which basically does take into account, if we know an aggregator is going to buy our loan in 3 days, or if an aggregator is going to buy our loan in 3 weeks.
Got it. Perfect. On the conventional side, major pools versus cash window. Can you touch a little bit on that? Is there a benefit to going cash versus not, and what is it worth the added responsibilities to create major pools and versus going cash?
So I'm going to give you my answer based on the size of the company that I'm in now, which I'd say is be a mid-size IMB company, because the answer is different depending on the size of your company and how much originations that you do. For a company of our size, going to the cash window is much easier than going out and creating your own securities. The reason being, I could have one $84,999,000 loan, and I could get a payout for a pool that is below $85,000 or 110 and below. Whereas if you're creating your own securities, you don't actually receive those payups unless you can put a pool together that has a minimum of $1 million into that pool. So for a medium-sized company, your best execution is probably going to be going to the cash window. If you're a larger company and you have the proper operations in mind that are able to handle that, and you have all the volume to be able to create all the different pools, then it could be definitely beneficial to be able to create your own securities.
Got it. Same with you there, Andrew. Anything there to add?
Yeah, I mean, I think another component of the major pools is that, it's tied to your, company's prepay speeds, right? So if you're, as a company, if you have better prepay speeds than what the market is dictating, then that could lead to better prices on your bonds. But a lot of that has to come with history, right? So an investor out there in the market or a dealer out there in the market isn't going to essentially pay you up based off of your most recent prepay speeds. It's going to take a look at your history to determine how fast your pools are paying off, and then kind of calculate the payout based off of that. So yeah, I think for kind of considering that, and considering a lot of people are if they're new to doing conventional securitizations, that's just something that I think they need to take into account to make sure that they're pricing that appropriately. Because at the end of the day, it's just managing that margin, right? So if your execution is MBS on the back end, you want to make sure that you're using that on the front end to maintain the consistent margin.
Got it. Thanks. So when I'm trading my pools, I try to always trade on swap. Is there ever an instance or reason why you would want to trade outright, Phil? Do you ever trade outright there?
For myself, I almost always trade on swap as well. We're hedging all of our products with TBAs, so we like to keep our hedges pretty tight, and I like to hedge in the buckets, and it's a lot easier to bid everything out on swap. Occasionally, we do have some securities that are a lot more illiquid. Some of the really, really lower coupons, or some of the really, really higher coupons, which I might not want to keep TBAs on against them the whole time, a fear of having to have a big pair off when I do get out of them. So I will occasionally put out some securities that will be outright, And usually my lower coupons or my really higher coupons could go outright.
And then I guess, Phil, we didn't really talk about this previously, but when you're trading on swap, are you usually doing it in blocks? Or I know there are some people that like to do it dollar for dollar, but from my standpoint, usually when I'm trading on swap, it's usually on blocks to kind of minimize the tail pieces that I have to manage.
Good point. I trade in blocks too. So, I try and get as close as I possibly can. But usually the smallest amount that I would do on swap is $250,000.
Yeah, and Ryan, I didn't kind of bring you in here too. From your standpoint, do you like it on dollar for dollar, or does it matter from the dealer perspective for the on swap piece?
Whether it's dollar for dollar or if it's on swap versus a round amount, doesn't really matter either way. It doesn't have significant difference.
Got it. Thanks. Brian, what about sometimes I get a lot of questions, pre-certification, post-certification. Is there a preference for on the dealer side? Can you touch on that?
I wouldn't say that there's a preference, but I would suggest doing post-certificate unless you're going to go with some type of variance. Most of the variances that we do see are somewhere in the neighborhood of 10%, which is, I think, pretty standard. You have smaller shops all the way up to much bigger shops doing about a 10% variance. So I would suggest post-certificate coming from my side of things, just because you oftentimes, if you sell that pool and a loan falls out, you're going to have a lot of issues as far as if your broker dealer sold it and then that broker dealer's got to go back, and it could be 1, 2, 3 already accounts down the road, and it's quite difficult then to get all those people to change it and facilitate the trade. So
makes sense. Phil, how do you trade?
I actually trade just about everything pre-certification. I like to trade pre-certification. I'd say we're probably at 99% accuracy when it comes to trading pre-certification. We look at all of our loans and make sure that from our perspective, they're dry before we put them into pools. But one of the benefits of trading pre-certification is when the broker dealers come out and they start to give indications for, say, a 275 or a 300. Back in the day, we used to do a lot of 100% FHA and different types of pools that you can create out there. The issue that you'll get is sometimes the multi will trade higher. And so I put out those, those custom pools, and I can test the waters. And if I get a good bid on the custom pool, I'll do it. If I don't get a good bid on the custom pool, I can easily add the custom pools to my multi-pool for whoever wins that pool. And I'll just create, from a 5 million multi-pool to, 2 customs in there, it'll become a 7 million multi-pool. And because I have not certified that pool yet, I can still change it and create what I'm seeing out there through the broker dealers in time to be able to get it done properly. Now, I will have to say, a lot of it depends on your custodian that you're dealing with and how comfortable you are working with your custodian. I've worked in my previous life with some custodians where it's a lot more difficult to determine what loans are actually going to make it into your pool or not. So you do need that variance.
Yeah. And I like to draw the comparison as kind of from a loan sale side, like selling a loan in docs as opposed to selling a loan that's funded, right? Most of the time it's going to be the same, but sometimes you are going to have those those deltas, or you're going to have a loan fall out, loan not kind of close. So I do kind of see it from both sides, and I would say, you know, just given some of the history and some of the things that I've seen, you know, it feels like there's definitely an advantage to taking the trade out pre-certification, because there was a moment in time, I mean, just given all the volatility that we've seen over the couple of years, where you're, you know, putting out a Lolo bow pool and it's actually back of screen, right? So sure, you'd want to collapse that and put that into a major, you know, no questions asked. So if you're already doing that post certification, then you'd have to go through the whole process of collapsing a pool, which I hear is a mess. I've never done it. I've never heard of anybody doing it, but I just hear it's a kind of
Yeah, Andrew, I'd like to jump in there. Once you certify a Ginnie Mae pool, they're not going to let you collapse it. They're gonna make you deliver it as it is, and afterwards, if you need to pull out a loan or something like that, you can pull out a loan afterwards. I've asked them to do that before, and they're just like, nope.
Wow.
So taking their lumps, yeah.
I'm going to ask you if you've collapsed, so I guess that answers that. So appreciate it. Well, that's some good color right there. I kind of want to jump in, change topics here, and talk about the pool bidding process and just how you guys are running your actual you know, pool bidding process. Andrew, what are the strategies you've used over the years? From, you know, from a hedge advisor's perspective, you have so many clients, so many of them are pooling. Can you kind of go over some of that, the history, and, you know, what's changed?
Yeah, I think, I mean, just given the array of clients that we're kind of managing on a daily basis, we definitely see all sorts of different strategies come into play. You know, some of the strategies are, you know, it takes a second to figure out what they're trying to do and what they've been doing, and to kind of talk to them and see if there's a way that they want to change the way that they're doing their pooling process. Because I think some of them, you know, they, in order to kind of get some cash flow efficiencies, they've gone ahead and they've just delivered into pools on good day settle. So essentially just taking that, creating that security and then delivering that security into the TBA, similar to an AOT on a loan sale side. So essentially the cash exposure from that trade position, TBA position, gets transferred into the loans they're using for the security. I think that is good in some instances, especially if you're, you know, if you could deliver it, if there's a negative pay up to what's on the screens, then, you know, that could definitely be a reason to use that kind of functionality. But I think at the end of the day, I think best practice is to, you know, create that security, you know, put it out to bid, take the best price, and then trade it on swap with as many outstanding positions that you have available to trade it on swap with. And that's how you're really going to achieve that best price possible for that security and for all the loans going into that security. So I think kind of just walking through the process with all the clients and kind of showing them, you know, the way and why we do it a certain way, definitely kind of, you know, make some light bulbs go off. I think the last client that I was talking to, who was doing it a different way, I was able to show him some efficiencies and how he could have saved, I think it was close to $4,000 on, you know, 2 pools if he would have done it a different way. So just kind of sitting down and walking them through the process, I think kind of helps, like I said, shed light on the on optimizing it and getting the best price possible.
Gotcha. And Phil, what's your process? If you can touch, yeah, I know you're on the Agile platform yourself, you're utilizing it. I wanted to see if you can kind of touch on how you used to put your bids out and your pools out, and how has Agile kind of improved your process, or how has Agile changed things for you?
Yeah, what's been nice about using Agile? So Agile, the way I use Agile now, it's housed in my MCT Live platform, which is great because it accomplishes multiple things at the same time. But in general, we're able to upload our bids to Agile. So there are multiple ways to do it. You can upload the loans and it will create the loan bids themselves, or like we like to do, because we have a lot of mods, we still have some CRGs. So all of our loans aren't in MCT every single day. So we upload the actual securitizations ourselves to Agile. Agile will then shoot them out to all the broker dealers that we do business with all at once. So it's a nice, easy process, shoots out everything to all the broker dealers, inclusive of if you're doing any swaps, bid on swaps as well. So it gives them all the information. So you're not sitting there having to have to communicate everything back and forth with each one of the different broker dealers that you're working with. When the broker dealers send the bids back, it's nice because the majority of them do it properly and fill out the Excel or go directly into Agile, and boom, it's all populated in sort of like a BestX type of display platform where you can see highlighted by green which broker dealer has the best price. So it has definitely made the pre-bidding process a lot easier. And then on turn, because you can program all the AOTs in Agile before you even send out the trades, the system actually goes through and figures out the swaps that you've selected and determines if an AOT is needed or if an AOT is not needed. And once you accept the trade, those security trades are boom in your system and in your hedge immediately. I do a few other things within the system. I do a lot of the assumed hedge advisor, and I use some of the other functions that are in there when I'm testing and figuring out exactly where I should be hedged afterwards. As Andrew and I talked on before, we use block bid on swaps, so therefore I'm not taking off the exact same amount I'm putting on. So sometimes after I do my trade, I could be a little bit longer or a little bit shorter, and it's all right there in front of me. So if I need to do something, I'm not spending hours on trying to figure out how to get my trades in the system or how to figure out my trades in my Excel spreadsheet. It just goes right through. And boom, I know what to do. And all of the AOTs will shoot out of the system, and we usually send them over to the broker dealers. And it's really cleaned up our securitization trading process immensely from the way we used to do it before.
That's great to hear. Yeah, so just to piggyback off of that, we do have an integration with MCT, but the whole Agile platform is open to any independent shop that's out there, and all that functionality is built in directly from Agile's portal directly. So glad it's benefiting you for sure. One thing, Brian, I'm gonna put you on the spot here, buddy. One thing when I'm trading, a lot of dealers are axed on the same, pool. They're, everybody wants a last look. I obviously want to keep all my dealers happy. How would you recommend an issuer, a seller, originator to kind of manage those relationships or those pools when everybody's axed on the same pool? How would you recommend us kind of divvy those out and not hurt feelings and keep everybody happy?
Yeah. So I feel like the ACT methodology has kind of changed over the years. Yeah, like you say, it seems like everybody's ACTs now, whether they truly are or not. And as far as the last looks are concerned, what I've seen more of is just people doing best in finals. It kind of negates that whole last look and acts and whatever, just because it will alleviate all those problems. So that would be my best recommendation. I've seen it firsthand where somebody says that they're axed on something and then they have 4 or 5 plus ticks in additional payout debt. Why didn't they show up at the beginning, right? So I think it's just a different trading group coming up now through some of these newer shops, well, not new shops, but newer desks that are not quite as old school, I guess, as some of us came up in the past. But yeah, I would say the best and final is probably the best way to go. So
got it. And then I wanted to kind of talk covers. Obviously on the dealer side, you guys want, color, cover. Andrew, actually, maybe I'll focus this question to you. What do you do if one of your clients one of your MCT clients does not want to provide cover? How do you handle a situation like that? Industry standard is to provide, cover and,
Right.
give that information out, but, not everybody follows suit. So how do you handle that?
Yeah. Well, before I get into that, I just want to say that I appreciate Ryan's comment there on best and final. I think that is a great way to do it. It eliminates the back and forth of the bidding process. I I understand everybody's trying to make people happy, but at the end of the day, if you're asked, you should definitely put your best foot forward, and that hopefully that gets you the pool that you want. But just to kind of touch on the color question that you asked, Twop, from a vendor's perspective, we're always telling our clients that they should be sharing that information with the dealers. It's not our position. Some of the traders will help facilitate the transaction, and the communication between the client and the dealers. At the end of the day, the client is the one making the decision on where to sell that pool, and the client should be the one sharing that information with the dealer. So if a client doesn't want to share it, we can't make them share it, and we're not going to step in the middle and share that information without their approval, right? So we're kind of a tough spot sometimes, because the dealers are always asking us, like, hey, what's the color on this? What's the cover? And at the end of the day, we kind of have a fiduciary duty to the client, to make sure that they're approving any communication that we're giving back to the dealer. So kind of puts the trader in a tough spot, but like you said, industry best practice is to share that information, and I think that does provide some efficiencies for the dealers, to be able to provide better bids in the future.
Yeah, thank you for that. And then Ryan, just to kind of focus a little bit more on that, let's say a pool is traded to you, and you're sticking out by a couple ticks. How much do you want to be backed up by? What is something that's fair for both parties?
So typically, the way you kind of want to break it down to, say, multi-pools versus more esoteric loan balance, MJMs type situation. Multis trade within a very slim margin.
Sure.
They're very broadcast. We bid them multiple times a day. Like it's pretty defined, right? So typically those trade in like a plus cover is like the max. And then with the more esoteric, depending upon the size of the originator, it's usually about a tick is what people like to be backed up to on something like that. Obviously not everybody abides by that, and you have to bid accordingly to those situations. And it kind of goes into that whole bidding process as far as the sharing of the color and backing up. When you get less information from the dealer side of things, that will be kind of reciprocated back to the origination list from that standpoint as well. So if you're getting no feedback, no color, no not knowing where your covers are or anything like that, I'd say as a rule of thumb, you would expect to get bids that aren't quite as strong as they might have been with additional color and things like that. So
Gotcha. Speaking to esoteric and I've seen niche tools come in, a lot of DPA tools are coming in, or clients that are just getting involved in the spec world. How much history does one need to get the better payups on, or like to have a track record? How much track record does one need to get the better payups on some of these pools?
Yeah, I would say from like a rule of thumb standard, it's somewhere in like the 6 to 9 month range, just to see a handful of speeds coming out to make sure that this isn't like a high refi shop and there's nothing weird going on with anything to do with the pools. So I would say just a pretty standard 6 to 9 months is a good timeline.
Great. And then follow up, not so much, I guess it is pool related, but we've seen a lot of, or I've seen a lot of dealers that are really aggressive on the TBA side, but they're not buying the underlying pool. Is there any reason behind that? Can you talk to that?
So I think in the market that we're in right now, with wide bid-ask spreads and on TBAs and everything like that, a lot of dealers are more aggressive on the TBA side of things versus, say, on some of the spec paper, and that kind of boils down to, as far as there's minimal payups, or actually negative payups on some of the coupons, and they don't really have a lot of value in them. So by, say, collecting a bunch of 4.5s or 5s or something like that, you're just kind of clogging your balance sheet full of tough, pools that don't have any value, and you're just going to end up delivering into the roll later in the month. So you're less likely to want to take down something that isn't going to provide you any, way to make money on them, versus, say, going after pools that do, provide value and are able to market them to our customers from the broker dealer side. So it basically comes down to balance sheet, how big your balance sheet is and what you're willing to put to work for that. So
well, thanks for that color. And now I kind of want to switch topics here and talk about just our platform, Agile, in general here. Andrew, how has the platform benefited your clients on the pool bidding side?
Well, as Phil mentioned earlier, just the ease of use, the fact that it's tied into your current hedge position, all the loans in the open pipeline are immediately removed, and then all of a sudden your TBAs are also removed at that point in time, whether they're traded on swap or if it's just with the same dealer. So you're essentially, your position is right-sized when you're clicking confirm. So it's a huge efficiency game for all the traders on our side, and then also all of our autonomous clients like Phil here, where they're able to do it on their own, right? So we just wanted to create an ease of use in the system to where we're removing that piece of the tri-party paperwork that's it really doesn't take a lot, but it's just a cumbersome process on top of what you're already doing on a daily basis. I know that there's probably some clients out there who would rather not trade on swap because they don't want to do the paperwork, which is silly to say, but I mean, it happens, right? You got enough stuff going on in the day. You don't want to sit there, print out or fill out a form and get it all figured out, signed, and sent over to the dealer. So the fact that we could just make that efficient, it's an easy process. So leveraging Agile's kind of automation of the AOT has been huge for us to kind of maximize that profitability for the clients on any pools that we're doing on swap.
Yeah, so we've streamlined that whole bidding process, to make it a more uniform approach for the dealers. Everybody's seeing things one way versus everybody piecemealing emails, and everybody has a certain different format. So we've tried to make that a lot easier on the dealer side. Phil, like, I know you said it's made your life easier. Like, can you touch a little bit more? Is it the AOT functionality, how we've automated that, or is it the whole streamlined process that we have? Can you give a little bit more color on that?
Yeah, well, it's a couple things. I mean, obviously, one of the nice things is in Agile, you have many dealers that are live in Agile. And then on top of that, we have no issues putting the dealers that are not trading on Agile into Agile as well. So the whole bid process works for broker dealers that are in Agile and not in Agile. On top of that, one of my favorite things why I first fell in love with Agile, I think I've already spoken about how much it helps my bidding process, in a lot of detail. So I want to add to that and say, being able to have more eyes on your TBA trades while the spreads are so wide in the Ginnie Mae pool is very, very helpful.
Yeah.
Because it ensures that you're making and you're getting the best trade that you can possibly put out there when you're putting on your TBAs, or you're taking off your TBAs, or you're rolling your TBAs. So being able to get out there to the field, being able to talk to your regional broker dealers as well as your primary broker dealers all at the same time, I think is extremely helpful, especially for your smaller to mid-size IMBs that are out there and are just either starting up or are growing and moving into the next phase.
Yeah, no, it's great that that's a great point. You know, you don't have to be an in-network Agile dealer to be able to get the emails and be able to read all the payups or drops and let it show within the UI. So it's saved me a lot of time too. And anything else? Sorry, go ahead.
I'll add one more thing. As far as reconciliation goes, at the end of the day, the trade is the trade. You know, you do a trade in Agile, it's done and it's not wrong.
Yeah.
So that is huge. When you do a trade and you write it down or write it into your blotter or something like that, you know, we type in numbers backwards, miss a decimal place. It has never happened since we've been Agile. Every single trade ties out every single day.
Yeah, no, we're very proud of that. It takes that whole human element out of it, the fat fingering, so it saves up a lot of time when you're trying to reconcile. Appreciate that part for sure.
My accountants love it too, because I make my accountants, confirm all the trades, so they're thrilled with it.
Yeah, the accounting finance teams are definitely happy with the system. Andrew, anything to add there?
No. Yeah, I think, being inclusive of all dealers, I think is a huge deal, right? Because even if they're not an Agile dealer, like you don't want to exclude them from the process. And just going through, just talking to clients over the years and just kind of understanding that they've all kind of done it through email, and we don't want to take or that optionality shouldn't be taken away from the lender. Right, so they still need to be able to achieve that best price possible. So the fact that the analysis, is able to capture all that information, and then just provide you an easy view of kind of where it needs to be executed, and then also from just dealing with clients, being able to talk to the clients and look at the same screen and say, hey, we're seeing this dealer here, this dealer here, this dealer here. Where do you want to execute? It makes it easier for us from a communication standpoint as well.
Yeah. Appreciate that. I mean, I think that's good for right now. I appreciate everybody's comments, and if anybody has any questions, please put them into the panel here, and we'll be happy to answer some.
So I did see something from Logan. He posted it a little bit ago, but he was asking, and maybe this is something for Phil, do you need a security custodian to do these securities with multiple dealers?
Yes. Your custodian, you have to be signed up for them to be able to receive and deliver the securities.
Yeah, I know that I've heard this over the years, and just speaking to what I've heard from the GinnieNet process is that they need to set a subscriber in the system prior to certification, and that subscriber is should be your custodian, but there has been times where it's been linked to a specific dealer. So in instances like that, you'd need to communicate with the dealer on either assigning that trade away from them to another dealer, or working with that dealer on how that process flow goes. But I think best practices, and what I've always told clients that are getting into this, is to set up a custodian to manage that process for you. It's an easier process to best ex the pools.
Agreed. All of my all the companies I've worked at, we've always had our custodian within the GinnieNet environment. So all of our securities went to that custodian, and we did everything on what's called DVP forms, delivery versus payment.
Yeah, and there's actually he has a follow-up here, and I don't know this, Phil, because I'm not on that side of it, but you have a better idea here. he's asking if it's pretty expensive. Just trying to find out if they're doing, you know, 2 to 3 million a month, if it's worth it.
If you're doing $2 to $3 million a month, you should not be securitizing.
I think he's talking about insecurities. Yeah, but
Even securities, you're going to do better with an aggregator for that small amount, because you're not going to get the payups. You got to remember, for each one of the custom pools that you actually create, the minimum size of that pool is $1 million. So if you're going to do, a 110 or a 150, that means you need $1 million of loans under $150,000 to create that one pool. So, to really be doing your own securities, you're going to have to be a firm mid-size IMB to be able to take full advantage of it.
Yeah, and I think, I'm not sure. I don't remember the kind of specifics of it, but it is I think it's on a percentage basis. There's a flat fee associated with the custodian, but then also a percentage basis on top of that.
There is. Yeah. There's a flat monthly fee, and then there's some variable fees with how many transactions they do. And then, what are you really looking for them to do? So we have our custodians do multiple things. So the cost for our custodian might be slightly higher than the bare minimum if you're willing to do more of that work yourself.
Gotcha. The other question that we have posted up in here is, who are the top buyers of Flow MSR right now? I guess they're asking from I guess if you're doing Ginnie Mae securities and you're doing a co-issue, I guess that would work.
Yeah.
So,
Bill, if you have any color there, that's probably a better question that we might want to get back to them on. But if you have any color there, we'd appreciate you answering.
It's not probably not for me to say, because I couldn't give you a definitive answer. I could go into Bloomberg and you could look up who the biggest buyer of securities are.
Yeah, Joe put that question out. We'll get back to you on that, Joe. And then, also anybody else that we don't really have that many more questions here, but trade-agile.com. Please reach out if you have any further questions. Let us know. We'll be happy to answer anything you put up. We'll also be out at the Western Secondary. If you want to schedule anything with us, please let us know. You can contact us through the website. Gentlemen, I really appreciate your time. I think it was very informative, and thank you very much.
Yeah, no, thank you guys.
Thank you for having me on. I appreciate it.
Appreciate it.
Guys. Thank you.